Welcome to FX Options University, recorded live at the International Securities Exchange, the world's largest equity options exchange. Join the industry's top trading professionals as they provide insight and strategies for trading in the currency markets using FX options. FX options are a low-risk alternative to hedging currency moves in any market condition.
Features, we're actually trading at 7:30 Eastern time now, which I think is great because it gives you another couple hours, especially in a day like today when you had a really wild day. Continuous quotes from market makers. I'm going to handle a question. Mary says her question is, she looked at ISE FX options a while back, didn't see much volume, and open interests were so low. What's happened because there's a lot more open interest now? Well, we've gotten some institutions. I've been spending a lot of time getting institutions to realize what this product is. And so now there are more institutions that know this is out there. We have more market maker participation. You're not going to see the trading volume. Well, I'd like to say that you're going to see it again tomorrow and the next day, but we had a lot of volume in the Australian dollar today, so a lot of volume in the British pound last week, massive volume in the euro in May. I can't guarantee that that's going to continue, but Mary is right. A lot more open interest today relative to 6 or 7 months ago. I think that you always should consider the bid-ask spread, not necessarily what the open interest is. You'll notice the bid-ask spreads are going to be probably the most reasonable in euro, Canadian dollar, Australian dollar, because that currency is a little bit riskier. There's a chance for it to go up and down a little bit more. Bid-ask spreads are going to be a little bit wider. British pound is also a pretty tradable product. Bid-ask spreads are pretty tight. But again, it's up to you. And if you're concerned about the bid-ask spreads, another great way to put in these trades or to think about strategies is to consider spread trading, where you buy one option, sell another option. So thank you, Mary, for your question. And these options that settle at the WM Reuters rate, noon settlement on option Friday, cash settled, European exercise. The premium is quoted in U.S. dollars, 50-cent strike prices. There are options on exchange rates. And again, there's so much. The other thing I like to say is fxoptions.com is a great place to go. It's a great portal. We're not selling anything there. We're just creating all sorts of free education. We want it to be so your first stop in your FX options shopping. That's your resource for FX options. And the skew charts are second to none. They are powered by a firm called LiveVol. Think that they're really, really, really great, and you can hit those skew charts every day. So I'll show you those back at the end of the presentation in a couple moments. Here are the bid-ask spreads a couple of, about a couple months ago. See, the bid-ask spreads were maybe 19 cents wide, 20 cents wide. The bid-ask spreads, back to Mary's point, are actually tighter today than they were when I took this screenshot a month or two ago. Let me go through an example of cash settlement. So if you own the 100 strike and it goes out at 104, you're going to get paid exactly $4 or $400. If you're long the 100 call and it settles at 98, you're going to get 0 for the call. But if you're long the 98 put, if you're long the 100 put and it goes to 98, you're going to receive $200 per contract. If it goes higher, then you'd receive nothing. That's how settlement works. What are the strategies available? You can buy calls or call spreads, puts or put spreads. You can sell calls with margin considerations, call spreads. You can sell puts and put spreads with margin consideration. You can trade diagonals, calendars, straddles, strangles, iron condors, butterflies. The one strategy that cannot be implemented is the covered call, but you can trade call spreads that replicate that covered call. You can also do hedging. So let me go through hedging, and I'm going to take all your questions. The notional contract size is 100 times the pair value. So let's just say that the U.S. dollar against the Canadian dollar is trading at 100.32. I know as of June 21st, it's really trading at 102.42. But for this purpose of this example, we're going to go and use the price of 100.32. If you're hedging your potential U.S. dollar strength, the U.S. dollar is the base currency, you're going to buy calls. If the dollar is the call currency, you need to purchase puts. If you're looking for dollar strength, if you're hedging potential dollar weakness, you're going to be looking for, you're going to get the dollar as the base currency, you need to purchase puts. The dollar is the quote currency, you need to purchase calls. Which strike do you buy? Well, obviously, the one that's further in the money is going to give you a greater delta, and it's going to cost more money. So that's how that works. Sort of risk-reward are going to be in line there. Of course, it's going to be the reverse for the puts. And so I hope that all makes sense. So hedging U.S. dollar weakness using U.S. dollar Canadian, if the position, if you owned $100,000 U.S. and you were concerned, let's say, what could you do to hedge? You're looking at hedging weakness. Let's say you're a Canadian investor and you have $100,000 U.S. and you're concerned. Well, what you might want to buy about 10 contracts. You're going to buy 10 puts then, because if you're concerned about the weakness, you'll be buying put options. So that's if you just wanted to do it sort of 10 contracts at a time. And then you have to decide which strike price. So you could do 10, or you could do what's called delta neutral trading, and I just took the deltas from live vol. You might buy an out-of-the-money option and buy 71 of them. You could buy the 98, 37, 22, 16, 13, and 11. The reason 11 versus 10 is that the 106 put might have a 90 delta to start off. So what's the delta neutral cost? Well, the delta neutral cost is going to be greatest, and then it's going to be much less. Now, if it moves slowly down, the best one to own is the 106. If it moves down quickly, the best one to own is going to be the 96. So it just depends on how volatile that movement is. If you're hedging U.S. dollar strength, so you're worried that the dollar may rally, what could you do? Maybe you're a U.S. investor, you invested, let's say, in Canada, and you're afraid the dollar rallies, what might happen? I mean, that's one of many scenarios. You'd look at the same thing, 10 call options, except now you'd be looking at, call options, and then you would look to see, okay, the delta neutral cost, the 96, you have 10 contract costs, the delta neutral cost, and the in-the-money one is going to cost the most, and the out-of-the-money one would be the cheapest. You could end up with 91 contracts, and if the dollar had a massive rally move, you'd be much better off with that 106. But if it moves slowly, you'd be much worse off. Here's the FX option skew. You can get this every day. I urge all of you to go to live. Now, you don't even have to go to live vol because we provide this at FX Options. And you can get the skew charts. And all the skew is telling us is the expected variance at different strike prices and different months. So the red is the shortest dated month, and then followed by the yellow and the green, light blue and dark blue. And the slope is going to determine, it's going to tell us where the volatility is at different strike prices.
Thank you for participating in this week's session. Please join us again next week. Get trading ideas, exchange rates, webinars, news, and commentary. Visit www.fxoptions.com. ISE FX Options can be easily traded through all options-enabled brokerage accounts. These exchange-listed securities are cash-settled in U.S. dollars and have a European-style exercise.